Our next section will be moving averages. Let's continue. All right, so moving averages are one of the most versatile technical tools available if you know how to use them, and of course I'm going to show you exactly how. The accepted method of interpreting them, that being support and resistance, makes them as subjective as any other indicator. They can become a self-fulfilling prophecy. We'll talk about that. Our method enables us to eliminate that subjectivity as well as all other indicators. What do we want to get from an indicator at any point in time? Trend, whether it's extended, and some other things, but we can eliminate all of that. We want to keep our charts free to be able to see price. That's what really matters. And the way we're going to use those moving averages, we're going to be objectively speeding up our initial analysis, and then we'll look at the details of what's happening. It's primarily very useful while scanning. Remember, what we're doing here as pattern traders is training our eyes and mind to recognize high probability patterns. Once we do that, we can then look at the details that we'll talk about as part of our Master Trader technical strategies. So, moving average misconceptions. One of them is that moving average crossovers are buy and sell signals. I mean, there are times where they can signal a change. However, we can do that just by looking at price. We don't need to use moving averages, as well as, there comes a point where we start to decide which moving averages. Of course, there's always a choice. However, difference in moving averages can make them cross at different times, which leads to more confusion. Moving averages are support and resistance. The only thing that is support and resistance that we want to rely on is price. That being said, some of the moving averages that we will use are so widely followed that traders and investors will react to them, and that's why we're going to use those. Moving averages, once traded below, becomes resistance and vice versa. What we're focused on there is when prices fall below a support area, and then that would become resistance. Moving averages are subjective from that point of view. And when you think about the fact that you can change the moving averages that we use, which would then change the area that you're focused on as to what is support or resistance, or the break thereof, it just leads to more and more confusion. So our moving average guidelines, we're going to use simple moving averages. You have a choice for exponential or some other type. Our choice is to use a simple moving average. They're widely followed, and when we use something that is subjective, in this case being a moving average, we want to use what the majority are using. Now, that being said, if you are taking this class and your focus is trading on currencies, Forex, you might want to consider using exponential moving averages, because that is the average of choice when it comes to something like Forex. That being said, it's not going to really give you any type of an edge if you don't know how to read the price action itself. We're going to use a 20-period moving average on all time frames. It will follow the trend relatively closely, and that's why we choose to use it. The slope of that moving average is going to be an indication of trend strength. Simple. If it's trending up, the trend must be going up. If it's trending down, it's going down. And as already mentioned, we're focused on just training our mind as to that picture and what we're looking at. The odds of a successful trade are going to be in the direction of the 20-period moving average. Another way of saying that, if it's going up, the odds are long. If it's going down, the odds are short. Converging averages point to inflection points. Why would that be if they're subjective? Well, because when we're using multiple moving averages and they come together, well, that means there must have been prices consolidating at that time, and volatility is contracted, and it's likely that it's probably going to start moving again. So we want to use keep the color of our moving averages the same and consistent, meaning because we use a 20-period moving average on all of our time frames, and I choose to use blue, Well, when I see a blue line, I know that it's a 20-period moving average. Simple. So moving averages are guides. They help speed up the analysis process, but price tells us when to trade. So we have choices. As I said, we're going to use a 20-period moving average on all of our time frames. And these are the time frames that we're using for our core type of trading and investing and swing type of trading. So on our monthly time frame, we use that for long-term analysis over months and years. Our weekly, we're going to be looking for setups for swing trades and core trades. We can use the 60-minute to refine at times or add to our positions. And on our daily, we're going to put the 20, the 50, and the 200. And on the 60, the weekly, the monthly, we're going to have our 20-period moving average. Keeps the charts clean, simple. We're just following the trends on those time frames. Now, when we look at our time frame with those multiple moving averages, here's our daily chart, our focus is the distance. Well, the distance between price and the moving average. The distance between those moving averages. The position. Are prices above the moving averages? Are they in between the moving averages? Are they potentially below the moving averages? And alignment. Alignment of our moving averages. There's the 20 above the 50. There's the 50 above the 200, and so on. They might be crisscrossing, and we'll get to that. Now, but we're primarily focused on trend alignment. Are all of our moving averages moving to the upside, which tells us that there's a strong trend? Or are all of our moving averages going sideways? Sideways whippy trend? Or are they all pointing to the downside? Strong downtrend. So the relationship between these moving averages, or between them and price, they tell us whether prices are overbought or oversold. And I really rather use the word extended versus overbought or oversold. As prices do become extended, they can become more extended, but at some point, the odds are increasing that prices are going to reverse back in the other direction. And that is what we're looking to do, and observe that objectively and quickly. A bullish or bearish divergence type of indicator. I'll show you how to do that. Possible guide to where support and resistance is. It's a helpful tool to anticipate where a reversal may occur, especially with the 200-period moving average and the 50-period moving average on the daily time frames. Risk-reward, which relates more toward being extended or not, and a relative strength measure. So here's an example how we would look at all of those using one chart. As I said, overbought can become more overbought and further away from those moving averages. And when we see prices moving higher and further away from the moving averages, odds are it's going to correct. And here we can see that it corrected sideways through time. It certainly could pull back. That's just part of observation as to the direction of prices. Can the moving averages point toward a turning point? Possibly. So what we do is we look at, is that moving average in alignment with prior support in this case? Now, of course, we can just look to the left and see if that's the case. But as I said, moving averages are speeding up the analysis process for us. So as soon as you see prices come to the moving average, the next part of your thought process is look to the left and see if it's in alignment with an area of price. We look at the distance prices are from the moving average and the moving averages from each other. As far as a divergence, right, as prices are moving up and we see that prices move away from the moving average, that tells us that momentum is speeding up. Now, as prices then, let me just back up here. As prices moved up here, you can see the momentum and the speed at which they moved. And then they consolidated sideways and then moved higher again. As prices then correct a bit, once we get a reversal bar here, what you notice is that the distance to the moving average is quite small. So what is that telling us here? Well, that momentum is slowing down. Of course, momentum can speed up again, but what we're seeing here, and what you would be seeing if you were using an indicator, would be what's called a bearish divergence. And I'll just kind of draw that in here and explain to you what the indicator is actually doing. As I've already explained, changing the settings on indicators will result in whether they actually reach an overbought level or not. But for the moment, let's just assume that this indicator is working. And as prices came up to this level over here and became overbought, most likely in a situation like this, they're just going to go sideways for a while. Say it pulled back, and then as it reached over here, it made a lower high. And using the moving averages, we're looking at the same thing as this indicator would be, but we're looking at it through the eyes of a moving average. And what we are using the moving average for is really to see what's happened here. Meaning here was speed, here it moved up, but it moved at a slower rate. So momentum was slowing down. Does that mean that we're going to take any action at this point? Not necessarily. As prices were moving up and we saw this happening in an area of resistance, let's say there was an old high over here. At that point, yes, we might start to exit part of a position. If prices were moving up into that prior area, and we covered volume, let's assume that on this bar here, this red bar right here, there was a huge volume spike. So as we put together the different pieces of information, our odds of pin downing a turning point become greater and greater. So we're using a combination of information that comes together to pick high probability turning points, whether that's to exit or enter. Now, when we look for moving averages moving together, we look for what we call railroad tracks, meaning they're moving together in the same direction with a relatively equal distance between them. And you can see here, the distance is relatively equal. Here it becomes narrower. And why does it become narrower? Because prices moved sideways for a bit versus continuing to trend lower steadily. Here we have convergence, which means the moving averages came together, and they came together. And they came together because prices moved up here for a period of time, and our 50 and 20 MAs, then they catch up here with the 200 MA, which is relatively flat, and it's flat because it's averaging in many more prices, so it moves a lot slower. On the daily time frame, the 200 period moving average will be a widely followed focal point. But what we want to see here is that these trends, the 20 and the 50 period moving average, are moving together in the same direction, which puts the odds on the short side as prices continue to move lower and lower. Let's move on to moving averages part 2. Moving averages part 2. Now we're going to consider the moving averages that we're going to use and the time frames intraday. On the daily chart, we stay with the 20, the 50, and the 200, and that's where our analysis starts for intraday trading. On the 60-minute chart, we'll use a 20 MA, and that's going to be our long-term time period when we're looking at intraday charts. The 15-minute, we'll use that with a 20 and a 200, and we can use that when it's needed to bring clarity to the 5-minute. Now, let me explain, what does that mean to bring clarity to the 5-minute? Well, if the 5-minute is erratic, the moving averages are slicing through the middle of prices, communicate a lot of uncertainty about what's happening, we can condense the data and go to the 15-minute time frame. If it still looks confusing, well, just sit on your hands. Don't do anything. Wait for things to start moving in a way that is recognizable. The 1 and the 2-minute chart, we'll use that for entries intraday when the higher time frames are in agreement. The times that we would use that is when the 5-minute is moving with momentum into a tradable void. In other words, there's room for it to move, and it's moving with that momentum, that it's not pulling back. We could use the 1 or the 2-minute time frame to expand the data and see more information so that we could enter. So here's our guidelines for day trading. Long positions are favored when prices are above the 20 MA on the 60-minute time frame. We'll find entry points on the 5 or the 15. Now, why above the 20 MA on the 60-minute? Because it's trending up. And so the old saying that the trend is your friend. So we're looking for prices to be trending higher, and we're looking for pullbacks or consolidations, bases on the 5 or the 15-minute time frame. Short positions we'll look for when prices are below the 20 MA on the 60-minute chart. We want to see prices trending lower, and just below that 20-period moving average, we'll find our entry points on the 5 or the 15. Longs will be considered when prices are extended below the 20 MA on the 60. In other words, we're looking for extended climactic types of setups on the 60-minute, but prices have stabilized on the 5, and we would quantify that by at least prices getting above the 20 MA on the 5-minute chart. Short positions are considered when prices are extended above the 20 MA, or a climactic type of a sell setup on the 60-minute chart, and then below their 20 MA on the 5-minute chart. So extended from the 20 MA is a guide. It could be multiple bars moving in one direction when momentum is moving and there's no stall. Here's an example of what we're looking for on the 60-minute chart. Here, prices were trending below the 20 MA, so we're favoring shorts. Once prices get above this 20 MA on the 60-minute chart, we start to favor long trades. And we continue to favor long trades as long as prices are trending above that 20 MA. Now here we see a gap on the 60-minute chart, so it had gapped up that day, which creates void right there and potentially a pullback. Now as prices move under, we then look for short positions on the smaller time frames until that changes, and then once above, we're looking for longs again. So here's an example, extended, but trend momentum is not slowing down yet. We say, is the move extended from its starting point? That's really the key. When moves begin, in this case, you can see that prices were moving down. They got a little climactic there. There was a retest. They started to move up above the moving averages here on the 15-minute chart, and then momentum picked up, and you see how the bars here are moving up in a fluid way. The openings are next to the closing prices, and that continues to happen, and you see the range is expanding. So clearly it's getting a little heated in this time frame, but realize that it's coming out of a base and a consolidation. So the move just began. So while it's extended here, and we would not be entering at this point, our analysis, and by what we're looking at right here, would suggest that it's continuing or will continue to go higher. Now think about what else would suggest that. We always have multiple pieces of our analysis, those concepts that come together that would suggest a move in one direction or the other, or continuation of that move. So think about what else we would need to see to support the idea of this move continuing in the direction that it was going. And the first thing that should come to mind is, what's to the left? Is there a tradable void? And if there is, then this consolidation, we would wait for that to mature, if you will, and then look to buy a breakout, or if prices were to pull back toward the 20 MA into this area here, we would then look to buy a pullback type of a pattern. When prices move far above the 20 MA, they went sideways, right? So that's bullish. What's happening there, we covered this in the support and resistance section, is that it's beginning to create a new support area. And the moving average is a visual aid. So as prices are far from the moving average, and notice the wide range bar and the topping tail, the extent of the move, which suggests it's going to pull back. As it goes sideways, that's bullish, and the moving average begins to catch up with prices. And think about, why is that? Because as it's dropping off the old prices, right, 20 MA, it's averaging 20 periods, whatever we're looking at, as it drops off the old prices and begins to average in more of the current prices, the moving average catches up. And when it gets close, and it doesn't have to be exact, but when it gets close, we'll be thinking that this is going to be the point in time when it should continue to move up. So here we see that there was a correction. Prices are under the 200, but the 200 is beginning to move higher. So what we know, what had preceded this was a correction where prices had been moving down. They had to have been stabilizing because the moving average here, the 20 period moving average, is flattened out and it begins to rise. But we know if we were looking at a longer time frame, we know that prices were pulling back for a period of time. And this could be in an uptrend on a daily chart, but having pulled back for 2 or 3 days on that daily time period and then stabilized intraday and then started to move up. Here we have a pullback into minor support. We have this converging moving averages right there where the 20 crosses above the 200. And while that is a piece of information, it's not a signal to buy. Meaning, the 20 getting above the 200 is communicating to us that things are continuing to develop on the bullish side because that moving average continues to move higher. And now it just crossed a reference point that we put on our chart here. The real information here that suggests it's going to go higher is the price movement and the fact that prices have been able to move above an area of prior resistance. Now as it continues to move up, notice the little stall next to this little prior high here, but it goes sideways. Bullish price action again. It's next to the moving average. Notice the little topping tail right there. There's no follow through to it in the green bar. Right here we could have an entry as well. Why? Prices are improving to the upside, bullish price action near resistance, and what I've already mentioned. And as it moves up from this time frame, we need to consider whether we want to take partial profits, what we're going to do at this point. So is there a tradable void? What is the chart pattern on the daily time frame? Does it suggest that it's the beginning of the move? And all of these things come together to put the odds in our favor. Railroad tracks, right? We've covered this, equals trend strength. And this is a 2-minute chart with a 10 and the 20, and you can see how they're trending higher here. We're actually looking at the same chart as we're moving down into smaller time frames. Notice the little downside breakdown that fails and comes back up again. This little failure pattern we'll cover in more detail later on. But bullish pattern, it suggests that buyers are continuing to step up here, and prices then continue to move higher, and then they create that support area. So here we have an example of a 60-minute time frame that's extended from the 20. It's extended from any resistance and has moved down to become climactic. And then it began to stabilize. So this would lead us to the thought of, okay, this is something that I'm going to want to consider for a intraday trade, a counter trend intraday trade for prices to move back up. However, the 5-minute is still in a downtrend. It's making lower highs and lower lows. It's beginning to stabilize a bit. It's still below the 20 MA. Notice the volume starting to pick up here. So there is interest for this stock in this area, but we need to see a little bit more evidence that buyers are stepping up and creating a new support area here before we're going to be willing to take this counter trend trade. Moving averages, they're an excellent tool. They're the only subjective analysis tool that we use, but we use it intelligently. It's not actual support and resistance, only price is. The ones that we use, especially on the daily time frame, they become a self-fulfilling prophecy as it relates to support and resistance. The 200 is widely followed. The 50 is widely followed by institutions as well. And they will buy almost without thought in a stock that's in a strong uptrend that pulls back to the 50 and or the 200. So we're going to use multiple time frames, support and resistance analysis. That's essential to use with the moving averages. And when you do that, as I'm explaining, the odds are in your favor and you are becoming a master trader. All right, we're going to move on to an advanced concepts of using these moving averages next. Advanced moving average method. We reviewed trend, momentum, and the price action through the eyes of moving averages in multiple time frames. Of course, we could do this just looking at the price action alone in those time frames. However, it is possible to know the trend and location of prices as they relate to moving averages in multiple time frames while only looking at one time frame. The goal here is to get the same information while viewing fewer charts and time frame. This keeping our analysis simple. Keep it simple, stupid. KISS method. It's actually very smart. Let's take a look how this is done. How can we calculate moving averages to see the trend and location of one moving average from one time frame and another? We calculate the number of bars in the lower time frame that make a higher time frame. And then we multiply that by the moving average in the higher time frame. That's your moving average in the lower one to use. So here's an example. We take the weekly 10-period moving average. It's the same as the daily 50-period moving average. Look at how many daily bars make up a weekly bar. So we have 5 bars times a 10 MA gives us a 50-period moving average. A weekly 20 MA is the same as the daily 100 MA. 5 bars times 20 equals 100. Simple. 60-period moving average, or 60-minute chart, I should say. 20 MA is the same as a 240 MA on the 5-minute chart. It takes 12 5-minute bars to make up a 60-minute. Times that by 20 equals 240 MA. We're actually going to use the 200 on that 5-minute because it's close enough. The 15-minute, the 20 MA, is the same as a 60 MA on the 5-minute. 3 bars times 20 equals 60. So on our 5-minute chart, we're going to use a 20. Right? We use the 20 on all of our time frames. We're going to use a 60 because it's the same as the 20 MA on the 15. And we're going to use the 200 because it's close enough to the 20 MA on the 60. Right? I already said it's the 240, but we're going to use the 200. And so from that 5-minute, we're going to know the trends and the moving average location on the 15-minute and the 60-minute, those 20 MAs, by looking at just the 5-minute. Let's first look at the daily and weekly. 10 MA on that weekly time frame is the same as the 50 MA on the daily. So here's the 10 MA on the weekly, and you can see the number here, 151.99. Now, it's not going to be perfectly exact, but it's close enough, and that's all we need. So here's your 50 MA, 151.29. So I know, not only do I know where the 10 MA is on the weekly time frame, which is going to track very closely the prices and the trend. So I'm looking at the trend, and is it sloping up? Is it sideways? Is it down? I want to know the location. And by looking at this daily time frame alone, I know what the trend is on the weekly time frame. In this case, it's up. So even though it pokes down, here you can see it's poking down under the 50 MA, it doesn't change the trend. You can see, and as it reverses back up, let's just go back to our candlestick analysis and retracements here. Here we have 1, 2, 3, 4, and retracements from down back to up. It's a bottoming tail on the weekly time frame. So as I look at this type of a pattern, I know that this was a bottoming tail bar because I know retracements, and I look at my 20 on the daily and I look at my 50 on the daily, and it tells me that they're both trending higher. And of course, we're going to get to the trend section, but our primary focus when we look at the trend is going to be, is it making higher highs and higher lows? And then with support and resistance, we see that a pullback, which should be a higher low, is in an area of support. I've got multiple time frames in alignment. I see this reversal here. It tells me to be a buyer above here. Bottoming tail on the weekly. Multiple time frame alignment. It all makes sense. So looking at intraday time frames, and with a bias, is potentially to trade this intraday, we always start with the daily time frame for our analysis. we form a bias. And here on the daily time frame, I've got a climactic type of a buy setup into an area of support with a bottoming tail bar, which suggests it'll continue to move higher. Now, looking at my 5-minute time frame, I've got my 60 MA, which tells me the trend. On the 15-minute chart, I've got my 200 MA, which tells me the trend on the 60-minute chart. And you can see the numbers here. They're pretty darn close. And the slopes of these moving averages is not exactly the same, but it's pretty darn close. And here we have the 200. You see where prices turned back up, and it's beginning to point up. And of course, now it has room to go higher. Right? We're always going to look at the price patterns. We're going to look at the voids. We spoke about volume. We can see a bottoming pattern here. Look at the volume with the bottoming tail, which broke down and turned back up again. The consolidation at resistance, the wide range bar igniting, the consolidation at the top of the wide range bar, the void above. So now, with that all being known, and I look at my 5-minute chart, you can see this is the end of a day here. But the alignment of these moving averages and the bias from this daily chart tell me that the odds are in the direction of higher. So I can buy pullbacks, I can buy breakouts, I can buy patterns that are in alignment with my bias. Looking at those moving averages, I'm waiting for this picture of moving average alignment on my 5-minute chart. I've already got my bias from the daily chart. I'm really not interested in this cross as a signal to act. What it tells me, though, is that prices are beginning to trend to the downside. And as the alignment here, the 15-minute trend under the 60, the 5-minute trend under the 15, and so on, as this is trending lower, here I can show you that the trends are beginning to track with each other. My bias is that prices are going to go lower, and I'm looking for price patterns that are in alignment with that bias to take action. There's a master trader concept. As those moving averages get close together in trend agreement, volatility contracts. You can see how they're getting closer together. And it should expand. Volatility should expand, meaning prices should begin to move faster in the direction of the trend and the void. There's no holy grail indicators here. This is just analysis that's based on master trader technical strategies. Here's not what we're looking for. And so this picture should be clear to you. That is just a whippy back and forth type of price action. And the moving averages, as already mentioned, are just a visual aid. So when you see moving averages intersecting through the prices as they are here, the message is stay away. There's a whipsaw going back and forth, back and forth. You can either move to a higher time frame to see if things smooth out, or you can just stay away. You have the choice to trade something else, or if you're just trading this particular instrument, you just wait for things to come back into agreement. Let's move on to part 2. Advanced Moving Averages Method, part 2. All right, so a little review first. When we're looking at moving averages, we're looking at distance, slope, position, and alignment. These moving averages are not actual support and resistance. However, there are others that are so widely followed, the ones that I mentioned, especially the 50 and the 200, that they can become a self-fulfilling prophecy. We're focused on the distance from the 20 MA. We're focused on the distance between the 20 MA and the 200. And here, as prices are under the 20 MA, the 200 MA, I should say, it's actually okay right here. And we're going to say, well, why is that? Well, because they've been moving down for multiple bars in a row. They've taken out this prior low. And while that is a confirmation of this bearish move, as you'll see when we get to retracements, that the majority of times after prices retrace greater than 100% of a prior move, they're ready for a short-term reversal. So this line, the 200 period moving average, is just a subjective reference point, meaning it's not actual support and resistance. It's a reference point that we use on the daily chart, and even though it's a little bit underneath it, it's certainly okay. Now, we wouldn't take any action here unless prices began to move back up and at least traded above the prior bar's high. So here is that daily chart that was moving down and moved just under the 200 period moving average. This gives us an intraday bias, an idea that prices could turn back up again. So we could look at the 5-minute chart with that bias. And it says any setup without multiple time frame analysis is going to be a gamble, and probably not a good one. Odds aren't in your favor. So now as we look at the 5-minute chart, remember we're looking for the alignment of these moving averages. The 20, 15-minute trend is the 60 period moving average, and the 200 is the 60-minute trend, the 20 MA on the 60-minute chart. And we're looking for prices to be above those moving averages, and these moving averages starting to move up. Now, at this point, prices are above all of the moving averages, but they're not. These moving averages at this point aren't above the 200. It's actually okay. This is at the beginning of a turn, and you can see right here that prices were going sideways into the end of the day, and then there was this initial move to the upside, and then this little choppy consolidation, and we haven't even gotten into the specifics of individual patterns yet, but this little move up and this pullback into this little area of support and this reversal is actually one of the setups that we'd be looking for, and then we look for this move up. And based on this move down on the daily, we know that there must be a void here, and of course prices were able to move up nicely. And then this sideways move into the 20 MA, this is what we called creating support, where prices pivot and then they retest, and then they moved up again, and then the process just continues and continues. And it says I know the direction of my 3 intraday time frames here by using one. Prices transitioned from downtrends in all time frames and up on the 5 and the 15, sideways on the 60. Moving up here, look at the 15-minute trend, moving to the upside. Again, our bias here is that prices will continue to move higher, or they should have. As I said, we always starting with the daily time frame. We know if there's a void, and we have a pattern that provides us our bias. Now, on this example, we have the 5-minute, and prices are just beginning to turn. Notice the 60-minute trend was actually down and flattening out. So we have the beginnings of a turning point here. The 20 is pointing up, the 15-minute trend, the 60 is pointing up, the 60, the 20 MA here is actually pointing down. So we're beginning to get a transition here. So this is catching our attention, but it hasn't turned all the way back up yet. But you can see the pullback into the support, the changing in trend. So we're beginning to look at with some interest that it could potentially move higher. I said, as always, we start with the daily time frame. What's the trend on the daily time frame? And here we have actually a sell setup. So here as prices pulled back into, and I'll say the rising 200 period moving average on the daily. This is, as prices corrected down and they're in a downtrend, the 20 and the 50 are pointed lower, and we have a sell setup. So this gives us a bias intraday that prices should go lower. So as we move to the 5-minute, and this was, you can see as prices had moved up into the 20 that day, they gapped higher, and then they came back down. So while we have an initial sell setup here, we would not be thinking of selling this short until possibly this area, but the trend is still up on the 60, so we're still not totally convinced, but it certainly should be on our list for the following day, looking for this to continue to the downside because of the daily chart. Again, we're starting with the daily time frame. What is the weekly trend? It's actually rising. We have a rising 50 MA. Now we got a 20 MA that's pointed down, so that even without looking at the price, obviously we are here, but even without looking at the price, the alignment of these moving averages would tell us that there must have been a correction against the uptrend on the weekly time frame. We have a reversal here, taking note of the distance, slope, position, and alignment again. And because of this turn, even though we did have a strong move up, as an intraday trader, it is possible to trade against the trend on the daily time frame, but at the appropriate time. So here, being up multiple days in a row, even though it's taking out this resistance, and this is a strong move, it's very possible this could move down for a day, possibly two, toward this area of support. The support here and these moving averages. So looking at the 5-minute time frame, prices have rolled over, and we could sell short based on that analysis. Daily time frame. What's the weekly trend? Up. We know that. The 50 MA is pointed higher. The daily setup is a continuation type of a pattern. Wide range bar up, little pullback, turn back up. We're looking for this to go higher. On the 5-minute time frame, we got some bullish price action here. After the gap up, prices were going sideways. Note the bottoming tail bar. Think about what that was prior to being a bottoming tail bar. And a big red candle that came down to the low of the day, where buyers were lurking and pushed it all the way back up again. Notice the topping tail bar. Here's the move to the new high on the day, and prices came right back in. Now this is the reality of trading, where prices actually broke out, and I would have had no problem buying above the high of the day based on the price action that preceded it. But you have to gonna put your stops down here, possibly even down here, and that's we'll get to money management rules on how we could do that and be okay, and then potentially we would then add to the position if the pattern set up as this one did. So we have moving averages pointing up. We've got bullish price action above the moving averages. The 5-minute is trending higher. We know the 15-minute is trending higher because our 60-period moving average is pointing up. And the 200 is flat, so the move is just getting started here intraday, but the daily says this has the potential to go significantly higher based on this price pattern. Here's another example. Daily chart, sideways. Weekly chart, trending up. Our 50 MA is pointing higher, but we've got a little topping tail reversal in the area of this prior gap reversal. So prices are revisiting a very bearish candle. However, this retracement is deep enough to take out this high. So overall, there is the potential for prices to move higher, but on a short-term basis, it certainly has the look that prices are going to pull back. And then looking at the intraday time frames, we see how the 5-minute is rolling over, the 15-minute is rolling over, and we have this nice move to the downside. Now, on this particular day, if we were going to trade this, we would never do it until this area here where prices started to break lower. Why did it stop at the 200? Well, in reality, we don't know because the chart isn't going to the end of the day here, but it's possible it did go lower, but it certainly did stabilize in this area. If you were trading this at this time and you saw this bottoming tail candle, the next step is to look to the left. Remember, whatever moving average we're using, and we see that prices begin to stabilize there, we look to the left to see if there's actually some real price support in alignment with that. Here we have a daily and weekly time frames coming together. How do we know that? 20 MA, rising and flat and rolling over. 50 MA has flattened out here. And as looking at the price pattern, you can see how the momentum has stalled and beginning to roll back over again. Prices did trade under this area of major support, and potentially it could move lower. So we would at least put this on our list, or at a minimum, set an alert here to see if prices were going to break lower. Here's what happened that day. Now, as you look at this, this isn't to suggest that every time you see a pattern that this is what's going to happen the next day. However, there is a void, and there is that potential. Now look at the 5-minute time frame. Look at the alignment of our moving averages here. Now at any point in time over here, we could have been taking a position, and unfortunately, when I say unfortunately, we're not getting paid immediately or getting our immediate gratification, but we could have entered here, we could have entered here, we certainly could have entered here, and on the breakdown. But there are going to be times where we get into positions and we're just holding until, for whatever reason, prices actually start to move. And we just manage at those times. Now, here's another setup on our 5-minute. Before you trade this, you have to define a bias from the daily time frame. Trend, support, resistance, void, price pattern. Then we look for our moving averages to be aligned. And this is the ideal, where the 5-minute trend is up, the 15-minute trend is up, the 60-minute trend is up, and prices have pulled back. Here's an area of support, and here's a retest type of a pattern, and then as prices then moved higher. Another example, just looking at the 5-minute, we go through our analysis on the daily time frame, and we have our trend strength on the 5-minute time frame. And again, we just look for price patterns in areas of support. We look for breakouts and so on. Multiple time frame alignment places the odds in our favor. That's how we use as master traders, using multiple time frames and viewing those moving averages in those time frames. What I just showed you as an intraday trader, it's not going to have you catching tops and bottoms, but you're going to get the meat in the middle, and the odds are going to be in your favor. These are one of the keys to success in you becoming a master trader.